Hey guys, welcome to Capital Cosm. Today is a very special episode. I have a returning guest in the form of Chris MacIntosh from Capitalist Exploits, but we also have Brad McFadden as well from Capitalist Exploits. I'm so excited to have them on the show today. Capitalist Exploits was the newsletter that started me off on my investment journey all the way back in 2020, and I found nothing but success coming from it, not just from a financial point of view, but also from an educational point of view. All the aspects of investing that I've learned, whether it be portfolio allocation, investing in the long term, not coming in and out, not trying to get too cute with these trades. I learned from Brad and Chris, so I'm super excited to have them on. And we're going to go through a number of different slides tracking the energy market, why they think the energy bull thesis is something you should definitely have on your radar. Capitalist Exploits is deeply involved in tracking the energy markets. Chris and Brad, for those who may not know who you are, go ahead and give the audience a background, an intro on who you are. Chris, let's go ahead and start with you.
Sure. So where do we start? Okay, we've got the publication business, which you just referenced. It comes on the back of an asset management business that we run called Glenorchy Capital. So we are fund managers. We're not just writing about this stuff. We allocate and invest our own capital together with that of high net worth clients. And we've been doing this for some time, most of our lives, whether that's a good or bad thing. You could debate. Certainly, it's one that we wouldn't be doing anything other than that, which we're doing now. It's a lot of fun. So, well, look, we're both from the finance background. I got a history in investment banking and then venture capital, and we started this business up. The asset management business in 2016, I think it was, and actually around about the same time, the publication. So the publication is based on what we're doing with our own and our clients' capital. And so there's a strong tie-in and an interest with respect to what we're talking about and how we allocate capital. That's not to say we get it right all the time. Sometimes we get it wrong, but certainly when we do get it wrong, we burn along with you if you're invested. So we have a strong bias and incentive, which is exactly, I think, how things should be. Yeah.
Yeah, so skin in the game, as the I guess Nassim Taleb would say. If you ever read that book, Brad, what about yourself?
Yeah, well, exactly the same with Chris. So I'm sort of partner with Chris and Capitalist Exploits and also with Glenorchy Capital.
Excellent.
Chris does all the talking, and I sort of I'm in the background. They call me the gimp. That sort of bring me out every now and then.
Well, this is actually, I believe this is your maiden voyage on YouTube, is it not?
Yeah, I've probably been on YouTube somewhere here and there before, but yeah, that's probably the first official time.
And for those who may not know, Trader Ferg is a big fan favorite on this channel across many other places on FinTwit and on YouTube. Brad is the mentor for Trader Ferg, just so you guys know. So if you guys enjoy Trader Ferg, you're in the right place now. Guys, nothing on this video is financial advice. Neither Chris nor Brad nor I are financial advisors, so please do your own due diligence. Brad, Chris, go ahead and take us through what you've got. Hey guys, quick pause and great news. I'm happy to share that after this video ended, I was able to get with Chris and Brad's team and secure a $1,000 discount on their Capitalist Exploits newsletter for all viewers of this show for a limited time only. So if you want to act on this newsletter offer, you've got to do it quick. It's not going to be here forever. You're not going to find this offer anywhere else. I use Chris and Brad to this day. I started my investment journey with them. I can't recommend them highly enough. So if you want to use the same newsletter that I read, then be sure to click the link down below, get your $1,000 discount, and let's get back to the video. Right there.
Yeah.
Oh,
cool. I'll just start with a few caveats, or if you will, before we head into it. And it's this. I think it's very important for folks to try and keep things simple. Don't get too caught up, and as we go through the presentation, I think you'll understand why it's more important to get the big trends and the big questions right, and not to get too caught up in the weeds. And that's having done so myself, right? I spent many years thinking that, what the Fed did in the next cycle, whether they hiked 50 bips or whether they didn't, I thought that really mattered significantly over in the markets. It does in the short term, but it does not have any impact typically on the long-term trends in motion. And those are really where you get the game-changing, life-changing types of results. What the PMI number might be coming out at. All of these things are really they're largely noise. Unless you're a trader. If you're a trader, that's cool. And we'll show you a chart within this where it actually comes from Dalio, and it's just through it's showing the long stage cycle, and we'll show you there where we clearly are at in the Western world, in the United States in particular, but in the Western world in general. And it'll put, I think, into picture many of the other charts that we're going to show you. And the reality is that we are in a time of significant change, and you can challenge that, and you can get pissed off with it, or you can simply acknowledge that it's true, and then adjust accordingly. And so we prefer to do the latter, simply because the former is not one that lends itself towards a palatable outcome for us. So over to you though, Brad. Let's rock on into the
Yep. So we are really genuine long-term investors. Okay, so perhaps what we should do is sort of kick off with this the extremities that exist within the market, bizarre behavior that Chris and I were talking just before we came on about remember the good old days of the tech bubble, Chris? The whole TMT.com bubble and all the madness around that. And it's like, yeah, well, we're here again. Didn't think I'd see this, and it's like almost like an exact repeat.
History keeps repeating, no matter what.
Yeah. So we have these extremes. This is value versus, growth versus value. This chart here. Sadly, I think if we could go back to let's say 1965, even the growth, the Nifty 50 craze, it wouldn't be as traumatic as this, or if it was, it would be on par. It's rarely have we ever seen this before. And
yeah, so you look at that 2000 spike up, you had a double top as opposed to a triple top, and nevertheless, I mean, you see a pretty discerning decline there from, I guess that's what, a 50% decline from the top in 2000 all the way down to 2002, let's say.
Yeah, I mean, the Nasdaq fell, was it 80%, 85%? The S&P fell 44, 45% in that time.
Yeah, and now you've got a triple top this time around.
Yeah, I mean, this latest dash up to a new high, almost new high again, has been quite bizarre. But hey, look, every bear market is different, has same sort of characteristics, but it's a bit different. So,
I guess the keys for people to focus on here is, again, keep it simple. It's easy to determine when something's expensive, and it's easy to determine when something is cheap. So whether this is, we could have gone back a few years and gone, oh, maybe that's the double top, that's it. Let's do X, Y, Z. Well, you should never have been long into something that was that extremely overvalued anyway. And if you're not in that particular hot seat, then it's largely irrelevant. If you're just focusing on where the value does lie, then a lot of these concerns around whether it's a double top or a triple top or whatever don't really matter. And so I think it's important for people to keep that in mind. If you stay away, one of the biggest things is what's Buffett's thing, right? Rule number 1, don't lose money. Rule number 2 is, don't forget rule number 1. And so again, when something is that extremely overvalued, just stay the hell away from it. And then look for where the value does lie. And if the value presents itself, you buy it. And that doesn't mean that it's going to go straight up in a linear fashion. In fact, you can and do have significant pullbacks. 50. We've had it in markets before, Brad. 50% pullbacks in any particular market, and it's still a bull market, and you keep riding it. So anyway, I'll shut up now. You can carry on having a look at.
Yeah, you know, it should be like a 5-year-old should be able to tell you there's something wrong here. And this reminds me of I'm showing my age, although I wasn't that old, but the late 80s, with Japan. So back then, the Japanese economy was about, I think it was about 15% of the world economy, 16%. And its market cap was about 44% of the world stock market. The Japanese economy, Japanese stock market accounted for about, let's say 40%, near enough, 42%. You know, and we have the same, and it's like a 5-year-old could say, hey, well, shit, that doesn't make sense. That's wrong. You know, and we have the same situation here now. So you take the so-called Magnificent Seven, I reckon 10 years from now they won't be so magnificent. But anyway, yeah. So you add them all up, and then you chuck in there in Japan, France, China, UK, and maybe you can chuck in Australia there as well, and I don't know, Singapore, and there we go. That's the Magnificent Seven. It's like, my goodness. I know there's women and children listening, but it's crazy. And then look at these look at the growth estimates that are factored in. So you say Microsoft. So it's forecast, analysts expect Microsoft to grow 15% year on year for the next 5 years. And if they were asked to forecast 10 years, I don't doubt it'll be any different. And then say, okay, well, that's fine for a small company, but a company the size of Microsoft to do that, NVIDIA, you know, Google to grow at 19%, let's say 20% for the next 5 years. I mean, are you kidding me? And then, of course, there's Amazon. That's correct. Analysts reckon will grow, you know, 90% a year for the next 5 years. It's like, they can't, because they will be the world economy. I mean, they'll have as much, you know, they'll be as big as the US GDP type thing. So we're going to get caught up in the weeds, the exact numbers, but it's just like, hang on, no, it's not physically possible. You know, it can't happen. Well, anyway, so that's what we're looking at. It's just these absolute extremes, and it's like, okay, and then we have the US stock market, which is sort of, so largely been driven by what tech stocks have been doing. I'd say some 70% of this performance would be associated with tech stocks. And so you have the US economy, which on a purchasing power parity basis is about 15% of the world economy. And then its market, it accounts for about 63% of the world stock market. And then you take things the other extreme, China. Yeah.
I mean, I was just gonna say that's completely insane. You look at the chart there on the left. I mean, you're in near 3 standard deviation territory. I mean, that's like that's a 1% chance of that just being random noise, just from a pure like statistical point of view.
Yeah. Yeah. Well, and then you say, well, you know, continue betting on that. It's like the odds are, you know, severely against you. Well, you're going to get your shirt handed to you. That's for sure. And so this, you know, this is exactly, now if we could repeat this situation with Japan, and let's say 1989, 1990 thereabouts, it would be exactly the same. And you know, that's the rest is history. Japan struggled, the Japanese stock market struggled for the next 20 odd years. So it's, you know, everyone thinks there's low risk in the S&P 500. It's extremely high risk. But let's not get too, I don't want to get too caught up in the bearish weeds. So now we start talking about our whole energy thing. And where do we start and stop with this thing? I think one of the big things is just, it hasn't been the CapEx gone into developing oil and gas reserves, and it's been capital starved. And that's going to catch up with us in a few years. We could debate whether it's this year, next year, whatever. I mean, you know, our positions are always 5 to 10 years. And so, you know, by 2030, which is only 6 years away, that's bloody scary. You know, we're going to see, you know, this lack of CapEx catch up with us. And in terms of oil is going to keep going higher. The demand for oil, that's life. Life as we know it is oil, and to a lesser extent, gas and coal.
Correlated directly with GDP.
Yes, yep, exactly. And so, it's going to play catch up. Now we could talk about, the whole shale thing, and the fact is, 70% of the world growth in petroleum productions come from the shale since 2010, and 30% come from outside that, and in the Permian Basin, we're almost through half the reserves in the Permian Basin. We could talk all that, that's all very interesting stuff, but it's all related. The reserves just aren't there, and it's going to play catch up. And all the money that's gone into the shale reserves in the US, we're pretty sure within a couple of years, the Permian Basin will be at full, over 50% production of its reserves, and so on and so forth. So that's the essence of it. I mean, we could talk about this whole, the whole move towards electrification and renewable energy, etc. That's
we've spoken about that before in some of the issues. So, like, despite over $2 trillion now having been spent on renewables, we, in terms of fossil fuel usage, we've still grown year over year. Right.
Yeah,
so we've gone and we've spent trillions of, I would say, wasted trillions of dollars in quote unquote renewable energies. And at the same time, the fossil fuel or hydrocarbon side of things has continued to grow in terms of consumption. And at the same time, there's been no or very little capital expenditure into them. And they're depletive industries. Like, it's if you think about it as a pantry, and you're going into the pantry every single day and you're pulling out food and you're feeding your family, at some point you've got to restock the pantry. And the problem with restocking this particular pantry is that it's extremely capital intensive and requires debt financing, which in the current markets is more difficult to come by, certainly in the Western world, where you have a lot of woke fund managers who are too busy figuring out what pronouns they need to be using, as opposed to going and investing capital into these sectors. And then we'll come to another element, which I think is in the next chart, which is one of the cost of capital, which is going up. So we have, remember what I said at the start? I said we need to be focusing on the major trends that are in play. This, folks, I would suggest is a massive major trend, and you get this bad boy wrong and nothing else matters. And I think if you get it right, you at least, at the minimum, probably have an opportunity to mitigate losses or to not lose money. I would suggest you could potentially make a lot of money. But the point is, this debt's not going to be paid back. And as it continues to rise, interest rates are going to continue to go up, because there is an inability for markets to continue financing it. We're already at the point, I think, by 2026, where on the current trajectory within the United States, the interest bill is going to overwhelm the ability to service it. That's unsustainable. And that, by the way, is it's not unique to the United States. Europe is in fact in a worse situation. So essentially, you have these incredibly indebted markets. The only way to solve that particular problem is either a default and or an inflating away that debt. Both of those scenarios bring about much, much higher cost of capital. Now you come back into what is a debt-financed industry, which is the hydrocarbon industry. So if you're a finance guy, let's say Brad and I are running an oil and gas firm, and we're looking out and we're going, okay, let's go put a rig out in the water. What's a rig going to cost us? 1.2 maybe?
Yeah, for
chuck a couple of OSVs on, 3 or 4 OSVs to run the thing. We're talking probably 2 billion, and we're going to finance it. So now we look out and we go, okay, what's the cash flows? We do all our numbers, but we're going to have to start extrapolating the cost of capital, not at current interest rates, probably at rising interest rates, right? And the more they rise, the more we have to extend that. The more those calculations change insofar as we're going, we might delay that. We might have to wait, because it's not the math isn't working quite well enough for us yet. And this is outside of the woke New York fund managers who don't want to get into this stuff. So basically, you have this rising cost of capital, and in an environment where you have the hydrocarbon space, which is in capital intensive, it's just another handbrake on supply. So this is a supply-demand equation. We don't even need, demand could actually fall, and this is what the deflationists don't understand. The demand could fall, but if your supply is falling faster in a depletive industry, guess what? Prices go up.
Yeah, it's
So
kind of
that's the situation.
No, I was just saying it's kind of counterintuitive from what you typically hear in the mainstream, in the sense that interest rates are supposed to kill inflation. What you're describing there is that higher interest rates create a higher cost of capital environment to build out these very high capital intensive projects, like building out an oil rig that costs you somewhere around $2 billion. All of a sudden, you have this supply headwind because of this high cost of capital that these central banks originally set to battle inflation, but point of fact, they're making it much worse down the line.
It's the difference between the finance economy and the real economy, right? Because the real economy matters insofar as that when you drive if you're a baker delivering your bread, and the cost of energy is higher, it means that your cost of your running your business is higher because you're going to have to drive X distance, and the cost of putting the fuel in your car is higher. The cost of the electricity that you're utilizing, or the gas, if you've got gas stoves baking your damn bread, all of these costs feed into the everyday. Like oil is the bedrock of everything within civilized society. So that when the price of energy goes up, inflation goes up. It's that simple. So it doesn't matter what the Fed does. It really doesn't. And so yeah, they could be raising rates in order to try and combat inflation. You're just playing with numbers. If those rates are not affecting supply of the underlying energy, it's not going to solve the problem.
Yeah, and it's more broad than that, Chris, because a few years ago, some genius had this idea that, oh well, we can grow corn and sugar and make ethanol out of it. And so now you got this direct link between the price of oil and ethanol, and obviously the price of corn and sugar, which is like, try taking corn and sugar out of your diet in the Western world. Good luck on that one. And then of course it's even double whammy, because the price of fertilizer will go up as well, because that's fertilizer essentially based on the price of natural gas. So it's yeah it's going to get interesting.
Yeah,
This chart here, it sort of also highlights the financial assets versus real assets. For a generation, it's been financial assets been doing exceptionally well. Real assets, perhaps with the exception of real estate, hasn't done so well. And we're still going to play catch up. So yeah, well, let's this is more Chris's talking point than mine, but
well, again, focusing on the big trends in motion, and so this is a long-term trend cycle. So there's a whole lot of cycles that exist. You've got sort of shorter-term credit cycle, which is roughly 30 years. You've got a long-term debt cycle, which you've probably referenced before, and I think probably quite a number of your listeners and viewers will be familiar with. You have a longer-term 250-year revolutionary cycle, and we are bang on all of these. Whether they take place or not, we don't know, but cycle-wise, we're there. And so, but I don't think you even need to necessarily look at that. You can see what those traditional cycles are like, and then you can see the pinpoints on them in terms of what would you look out for to identify whether you are or are not in any of those cycles. And it's pretty damn clear. So we have huge wealth gap. We have a loss of competitiveness, and this is largely a Western phenomenon, loss of competitiveness, less productivity. It doesn't have it in you, but it's essentially higher socialism or higher levels of socialism, massive debts, more printing of money, conflict, the threat of loss of reserve
Well,
currency status,
well,
weak
take
leadership.
the US. Take the US now, Chris. That's at number
Perfect
15,
example.
internal conflict.
Exactly. We're watching it transpire. And so I remember making these calls back in sort of 2018, 19, and having a number of Americans in particular calling me out saying, "You're not American. You don't know what you're talking about. You don't even live here." And I'm like, I don't need to live anyway. In fact, I could make these calls based on South Korea or any other country. If you look at the cycles and you look at the mathematics behind that, and you look at the monetary policy, and you look at the social structures and all these things, you can see whether those are true. And when they are true, you point them out and you go, "Hey guys, by the way, this is a cycle. This has existed for hundreds of years. And look, here are some of the elements that indicate that you're in the cycle. And they happen every time. And here they are. And people still don't want to know about it. They're like, no, you don't know what you're doing." Anyway, the point is these are major trends in motion. And it's futile to sit there and think that you as an individual are going to stop them. You're not. They have to run their course in the same way that, in the Australian bush, if you let the debris lie around for too long and you don't burn it off, guess what? You're going to have a big bushfire, because that's what fucking happens. And so, we're due a bushfire, and you're not going to change that. Now, but what you can do is acknowledge it, understand it, and then take measures to precautionary measures. And I would suggest even attacking it. We like to sort of attack these things, because the reality is, in these times of significant change is when absolute fortunes can be made. So I think it's a great visualization of where we're at, largely in the Western world. Again, these things are unpopular to talk about, but we don't shy away from things that are unpopular just because they're unpopular. We're here to make money. So
That's your edge, actually.
it is, because you have the asymmetry only exists as a consequence of a disconnect between the narrative and the reality. I think it was Nassim. Was it Nassim? No, it wasn't. It was Soros.
Yeah.
Who, despite being a disgusting individual, was very, very sharp and
The
intelligent
premise,
trader.
bet against the premise that's wrong or something like that.
Yeah.
And yeah, he said, identify the narrative or the premise that is wrong, and then bet against it. That's how you make ridiculous amounts of money. And so we believe that that's where we're at. So we go to
And
the
that's what we
next
do.
slide.
You to myself. Yeah, that's essentially what we do. And here we go.
Yeah.
So
and I just want to say, much to your credit, Chris and Brad, you were talking about this stuff before things got really popular on YouTube and all these other financial outlets in terms of commodities, energy, uranium, oil, gas. You guys were all over it in 2020 and even before that. So just a shout out to you guys just for catching this trend before anyone else was.
yeah, we are long-term investors, but we'll show you the uranium thing. That was a classic example of being patient and getting a payoff for it. So S&P Energy Index, and unfortunately, we can't go back any further than this because that's as far back as the indexes go. But you get a fair idea. So energy stocks, so let's say Exxon, Chevron, etc., as out of favor as they were relative to the S&P 500 in the tech bubble. Yeah, and of course they were a little more out of favor at one stage. At one stage, was it 2020? Yeah, I think it was late 2020. Tesla had just a bit more market cap than all the energy stocks in the US stock market.
You mean it still doesn't?
Oh no, I think it's lost. I think it's lost a bit now, but it's still. I mean, the market cap. I think the weighting now is it's still near record lows. Yeah, it's hilarious. So then,
Still trading at like 50 times earnings.
all you got to do is just get behind. I mean, what you sort of said before there, Chris. Get behind these trends where the wind is going to be beneath your sails as such, and it's even a 5-year-old could do it. Although a 5-year-old's will not have the patience that someone who's old and seasoned like us will. Cool. Yeah, we've had some good runs in coal stocks, especially if you had dividends on top. This is a Bloomberg World Coal Index. Again, it's a shame we can't go back further. We've said before that coal for the next 15 odd years will be like what cigarette stocks from, say, 97, and until 15 years after that, 10, 15 plus, plus or minus. It was the best performing sector. Outperformed, even with the tech stocks. This is up until about 2016, 17. Outperformed everything. Was best performing sector when you added dividends back on top, and we think that's going to play out here. But it just takes a lot of patience. It's all very well to say, be patient and have patience 10 years, but cheapers 10 years is like a long time. Okay, now, Chris, this okay, so we're taking here the Cameco, all right, as a proxy for the uranium sector, because we don't have any uranium stocks that were around for too long. I mean, they come and they go, but Cameco has been there. So we'll take this. It's just relative to the S&P 500. And it was late 2016, October 2016. Chris and I were looking at this at uranium stocks, and they were bottoming. And it's like, hey, something's going on here. I don't quite know what it is. I mean, we can make a decent argument, but who knows what the real deal is. But something's going on here. And so we bought a basket of uranium stocks, and we kept on buying, and we thought we'd got the bottom, and we did. Near enough. Okay. This March 2020 was the bottom, but anyway. The point being is we bought and we bought and we bought. We believed in the thesis, and 4 years later, so September 2020, nothing to show for it. It's not so obvious here because this is a relative chart, but nothing to show for it. Like exactly where we were 4 years prior, and it's like, jeepers, how long is a piece of string here? And then things took off, and then within 12 months, 18 months, we're up 3 or 4 fold on those original positions. Some geniuses, of course, he bought it, at the bottom in 2020, near enough, we're up 10x. But so, and it's still got a way to go. But it's losing its asymmetry a bit. I mean, it's already started to move, and guess what? People are talking about it. They weren't talking about uranium stocks 4 years ago, that's for sure. It's like dead in the water. But it's got more way to go, and we say patience, but cheapers. Who's got? 4 years was long.
Yeah, I actually saw Chris for the first time on a podcast. I believe it was George Gammon back in April or May of 2020, and then I signed up for the newsletter, and I actually allocated at that time, like right at that very bottom, right there, like just luckily, because that was at the heat during the heat of COVID, back when we're all under house arrest, had nothing better to do.
Yeah.
Well,
you timed it perfect. Genius. Yeah.
Yeah. I just read some of the thesis that you guys laid out, and made perfect sense to me at the time. That was before we had a huge run up in the stocks there. But I mean, at that time it worked out well. Doesn't mean always well, but
Yeah. Look, there was actually more to it. So a couple of years later, so we're now 2019 to 2020, or especially 2020, 2021, you had uranium on its knees. Don't want to touch it. Oil on its knees. It was negatively priced at one stage. Okay, that's a bit weird. Coal. Don't want to touch that at all. It's and natural gas, the same. And so you looked at all these things, you go, okay, all these markets and the oil and gas service stocks, although all going bankrupt or having to recapitalize, and likewise of tankers. So it was back then, it was priced as if the world as we know it would come to an end, because without hydrocarbons and transporting the stuff, well, without hydrocarbons, full stop. Well, saddle up the horse, darling, because that's what you're going to be doing. Life as we know it's over. You got petrochemicals, plastics, transportation, food. Good luck on harvesting food without a tractor with diesel, and so on and so forth. So it was almost like, okay, well, let's just go buy uranium. We'll go buy coal stocks. We'll go buy natural gas stocks. We'll go buy oil and gas producers, some service stocks. What else have I forgotten? And I'll just chuck in some hydrogen stocks in there just for fun of it, because one's gonna win at least, and that one winner will be up 10x when it's all said and done. Of course, traditional hydrocarbons coming back. Hydrogen was it was just a speculative idea for a short period of time. So it was like, it's a natural hedge. You take away uranium. Remember, this is the Germans are shutting down their their nuclear power plant. So you take away uranium, what are you going to fall back on? Only two things. Natural gas and coal. And it's going to be more so coal, because natural gas, it's you're limited in terms of of the ships that can ship it around, and ports that can take it, and so on and so forth. Whereas coal, just dead easy, chuck it on a ship and away you go.
Which is also why when Putin went and blew up his own pipeline, it was such an obvious trade. It was coal, because that was what could be shipped in to meet that deficit. And it wasn't. And then at the same time, you realize that there's absolutely nobody who wanted to buy into any coal, and the companies were trading at sometimes like 2 times earnings, with 15% dividend yields. Like, you're a moron not to buy it, despite any shenanigans going on within the European energy markets. So you get these setups, which it's sometimes, Brad, you and I sit here and we scratch our heads and we're like, are we missing something?
Yeah.
Like,
what are you missing?
What's wrong with people?
Yeah.
How important is geopolitics to this thesis here? Because I mean, you're able to ascertain that much just by looking at a geopolitical event like the Nord Stream pipeline.
Yeah, look, I mean, here's the thing. When you get to the bottom of typical cycles, so commodity markets are quite easy, right? They run 7 to 15 year cycles, and sometimes they're extended and sometimes not. And no bull market's always the same, and no bear market's always the same. But the general trends are in place, and they keep manifesting for the very reason that supply and demand matters, and capital costs matter, and all these other elements that we've touched on matter. And so you don't need to have exogenous external events such as geopolitics to have any of this take place. That being said, they can really change the dynamics of any given market significantly. Certainly, if you go and you think about World War II or any major conflicts, they can change the landscape significantly. The other element, just touching on geopolitics, is, again, if you go back to that, that you don't have to go back to it now, but the cycle of long-term cycle that we're referencing there, that Dalio had, when you go through what is essentially massive regime change, global regime change, then the dynamics, so it's not going to change the dynamics of, say, a credit market. If there's a bond market that needs blowing up, it's going to get blown up. If there's a currency that's due for getting taken out to the woodshed and given a hiding, that's going to happen. If the commodity markets are in a bear market, they're likely to go into a bull market. And so those dynamics don't change, but it can change things like alliances. Who actually benefits within the commodity space, who doesn't benefit. Those things are interesting to watch now, and we can actually we're watching that play out. For example, if the three of us decided we were going to get together and build a coal company, hey guys, let's go and do it in Germany. Well, guess what? Hard luck. We're going to struggle, right? Because we're going to have to fight with the greenies, and we're going to have to fight with the regulators, and we're going to have to fight with the EU, and it's just going to be a real headache for us to actually get anything off the ground. And that can be, and is, despite a bull market in coal. And so it matters also where geographically the money will be made. And so that that tends to change with geopolitics, but it doesn't change it doesn't typically change the fundamentals. What it can do is accelerate them. So, I referenced, for example, the blowing up of the pipeline. We've got now the Suez Canal being problematic, shall we say, for shippers, which is adding another 12 days to the shipping cycle, which is fantastic for all our shippers, because guess what? Their day rates are just climbing and they're just spending more time on the water making more money. So it's those dynamics, when you see that we're going through this geopolitical shift and conflict, you don't know exactly what it's going to look like, but you do know what that typically does to particular markets. So if you go back to World War II, for example, one of the best sectors to be invested in was, guess what? Shipping. For the same reasons now that shipping is doing well as a consequence of the conflict within the sort of the Suez Canal in that region. So we can, on a probability basis, we can make a judgment call saying, probably we're going to have constrictions of supply with respect to trade routes. We're probably going to have sanctioning of certain countries. Whatever those countries produce is going to be a limited supply, whatever it is, whether it's rare earths from China, whether it's Saudi Arabian oil, whatever.
Inflationary.
And so all of those elements can also give you a very good picture as to what kind of market environment you're in. It is typically stagflationary. So we've been making the judgment call that that's what we're heading into. And certainly that's been the result so far. And I think it's just going to accelerate. And so it's not even there's the folks calling for a deflationary environment. It's like, no, you're losing focus on what's going on. In an environment like this, which is a conflict environment, certain assets do very, very well because they're constricted in supply. Typically, it's energy because you don't have any political sovereignty without any energy sovereignty. And so that's going to get and will be fought over. Trade routes get blocked, sanctioned, and so on and so forth. That restricts supply. That's inflationary. I mean, you could just be a bloody plumber. And if you can no longer get the little goodies to tie your plumbing together because they're coming from China and China's just been sanctioned and now you've got to get them from Indonesia and they cost 5 times more, whatever. All of these elements add into a higher cost for you running your business. And so all these things feed through into the market. So it does matter. But again, it starts with the fundamentals of supply and demand. And again, keep things simple. It's easy, as Brad is showing you guys, it's easy to see what is cheap relative to what is expensive. So you don't have to get too caught up. And we're fascinated by it. I can talk about it all day long, but the point is you don't have to listen to me talk about it all day long because you're probably going to get bored. But you don't need to know that much. You just need to see what is cheap, what is expensive, and then have an understanding of how you would go about building a robust portfolio. And that's about asset allocation and weightings.
And that's all the easy part, Chris. The hard part's the waiting. Yep.
Well, that's the thing. People don't have patience.
Tom Petty, the old Tom Petty song. The waiting is the hardest part. Yeah. So
I was just gonna say, you guys use ratios to determine what's cheap and what's expensive. So you're not just pricing things in dollars. You're asking the question compared to what? For example, you're looking at the O&G services sector versus the S&P, priced in the S&P. So that's when you determine, is it time to, if you had a choice between the S&P or oil and gas service companies, by the looks of this chart, you would choose oil and gas services companies just because of their ratio.
It highlights areas to look at. And if you just go around the world looking for situations like this, you could take the Greek stock market relative to the S&P. You could take Argentinian equities and so on and so forth. And so, you construct a portfolio that all looks a bit like this. You see buying things that are unloved. Well, not unloved, they're just like, castaways virtually. We like to say we invest in sectors and markets which are vital for the functioning of society, which have been left for bankrupt. And the ideal situation is when you do get these things out, they come out of bankruptcy or the price of bankruptcy, It's not always like that, but yeah, it's a good starting point. And so yeah, okay, oil and gas services versus S&P 500. Mm-hmm. Well, and then what gets even more interesting is if we do this. So we're using Schlumberger, well, I call it SLB now, as a proxy for oil and gas services, and then we're using Chevron. We could have used Exxon, whatever, as a proxy for oil and gas producers. And so we don't have indices that go back far enough, but this is fairly good. And it just stands to reason. I mean, oil and gas services, relative to oil and gas producers, they should bounce around, plus or minus 1. I mean, I haven't indexed this here, right? But you can see here, for how many years, up and down, it's a pretty fair idea of when it's cheap and when it's not cheap. And then, hello, look at this. People ask us, which sector's got the most asymmetry in the world? And we go, well, we don't want to pick one sector. And then we sort of, go, okay, mutter and carry on. But yeah, it's fascinating. Okay, and all right, we just picked oil and gas, offshore oil drillers. So we're looking at rigs here, and this is sort of also really, really important. It's okay. So CapEx has picked up a bit over the last couple of years. It's not remotely what CapEx was back in 2012, 13, and 14 in terms of oil and gas CapEx. Nowhere not like that. And yet, look at where the utilization rates are on rigs. So we're almost back to where we were in 2014 on floaters, that's semi-subs and drill ships. And if you take jackups, which is 400 feet and less water where they operate, they're at 90% utilization plus or minus. You can argue over, but you're essentially there. So, if a bit more. Okay, put it this way: the infrastructure out there there's not the capacity in the infrastructure to absorb all this capex that's going to be hitting the oil and gas sector over the next 5 years, 10 years. There's not enough, for example, jackups and floaters, etc., to drill wells. And it's not just that; it's the capacity to do subsea services, offshore service vessels, and so on and so forth. Capacity to build to produce drill pipe, and and a whole bunch of other things. So it's like, well, here we go. And so, you just have more jackups built and floaters. Well, good luck on that one. Shipbuilders. There's only half the shipbuilding capacity there was 15 years ago, and those shipbuilders are chock-a-block building. What do you call it? LNG, LPG carriers or liner ships. Probably 2027 is when you could probably get a berth to get a tanker built. But mention, I want to go. Yeah, let's who's interested in building a drill ship or a semi-sub for us? It's like, well, you guys sent us bankrupt last time. Freaking no way, And then who's going to lend the money? Back then, so we're going back 10 years, you could get a drill ship built with like 10% deposit, likewise with a floater. And now it's like, no, 40% deposit. And at what price is that? So the point being, I won't say this time it's different, because eventually, there's going to be oversupply of rigs, etc. But I suspect the duration and magnitude of this bull market will surprise most because of supply, the lack of supply. Ooh.
It's like someone just flatlined on the surgery bed or something.
Okay, it's a bit. Look, it's a bit but for the astute out there, they were saying, but hang on, didn't Frontline wasn't recapitalized? Didn't it capital structure change? It's like, yes, it did. So you got to sort of factor that in. But even without that, I mean, tankers relative to the S&P 500, like unloved, unwanted. And then just go back to this is what gives us hope and passion and exuberance. You go back to, well, the late 1990s, early 2000s, and see what many of these things did, be it uranium, be it tankers, so on and so forth. What they did, they went up goodness knows what relative to the S&P 500. Now, this is, we want to give everyone hope. It's not, so we're putting on our I don't know, we're getting out our top hats. And we're going back a few years here now. And so Chris and I both had the fortune of living through the tech bubble. It was dramatic. So, all right. So people will be saying, oh, well, you're talking about a bear market and, let's say S&P 500 and it can be prolonged, etc. It could go down substantially, whatever. Or just be out of favor for a long time. Well, should we not invest? Let's just get out. Or no, not so quick. So in the tech rec bear market, S&P down 44% from top to bottom. If you want to, top ticket. You think, well, everything went down. No, if you took away TMT stocks, technology, media, telecommunications, and you had a special focus on sort of old economy stocks, or let's say sectors, be it steel production, be it or home builders. These things, and I'm taking home builders index here as a bit of a proxy. It's accentuating things a bit, but it gives you a good idea. Home builders, you can see there, this is all indexed to 100 as of 97, because that's as far back as the home building index goes. Home builders lost 50% from 98 until, let's say, March 2000. 50% on an absolute perspective. Whereas the S&P was up, whatever, what's that? 80%, near enough.
123,
okay. Yeah, and of course, yes, if you look at tech stocks, they're up goodness knows what, even on top of that. All right, and then this is weird because, from March 2000 to March 2003, S&P down 44%, home builders up 150%. Okay, that was a bit of a, when there were financial stocks did exceptionally well. Look at New York Community Bancorp, the one that just got smashed. What it did, that was up, 6x or 7x in that time. It was freaky. The amount of value stocks that came racing back and money, and you don't have to be a genius. I mean, even things like 3M. Okay, 3M, Scotch tape and good. That didn't go down. So even if you look at the Dow, the Dow I think dropped by about 20%, 25% at most, and most of the damage there was done in the last half of 2002. But the point being of all this is that if you buy things that have been unloved, unwanted for a long period of time, gone down substantially, but they're vital for the functioning of society, you can come outside of a bear market, a nasty bear market, and having made good money. But there's a proviso there. It is bloody hard. I mean, that was nasty. Even so, I mean, look at some of those pullbacks you had. Okay, 9/11 was in there as well. It didn't help matters, but anyway, so that's what we're thinking. We're thinking that we're going to have a repeat of this sort of behavior for next, 2030 is only 6 years. That's not far. It's going to be difficult because it's going to be very, very, you'll have pullbacks and things, but we're okay. The things we're buying, it's just completely unloved, as you've seen in the previous charts.
Yeah. So, I mean, we've already kind of moved quite a bit. I believe it was a 300% move within the confines of 2020 all the way up to 2022. It seems like that's more of a preliminary, pre-show to the main event there. Is that what you would say as well? This is more the
What,
first few innings.
in terms of what? In terms of some of these like uranium stocks and things like that.
Yeah. So if you look at the commodity sector as a whole, things like the Thomson Reuters Commodity Index, I think they move something along the lines of 200 to 300%
Yeah.
from
Well, it depends
2020
where you
up
take the
into.
time. Yeah. Depends where you take the time frame from, but I always like to take it from a sale of 2020 because obviously, March, April 2020 was like
Mhm.
everything that went bloody haywire.
Yeah.
And so, we're just off the bottoms. So we're a couple of years into a 10-year bull market and all the things we've talked about. Yeah. That's enough. Lock away the gimp.
Look, we.
So it's exciting times. We are very, very excited.
Yeah. Yeah. And
All we need is these pesky bloody magnificent seven to start, come falling on tough times. But it'll happen. Yeah, it'll
yeah.
happen.
And I think unlike this time, what is this, 97 all the way up to 04, you have so much right tail risk this time with all these sectors. For example, you've got the stuff going on at the Red Sea. You have all these conflicts that could pop off at any time. These are all, like Chris mentioned, inflationary or stagflationary, better put.
Yes, you could easily argue there's a whole bunch of factors in here that could really accentuate things. You've had how many years of underspend on capex and oil and gas. You've got this massive bond bubble. You've had interest rates just coming off generational lows or lowest in a couple of generations, so on and so forth. So yeah, I mean, everything's in place here for the sort of massive bull market we saw many of these cyclical industries from 2003 to 2007 for this one to be much bigger than that.
Yeah. So this is big picture signal from noise view. So many people, biggest mistakes that they make is that they're tied up in the day-to-day. A lot of the day-to-day is noise. When you actually peel back, you sit back and you look at this entire thing as a whole, you can see the elephant, as opposed to looking for an elephant with a magnifying glass, trying to, make of it what you will.
Yep.
It's like I said before. So you've seen now, folks, you've seen the charts, right? And if you think about, say, the offshore oil space. So if we are to get additional supply, that's going to require capital expenditure. So it doesn't matter what the Fed does. Like it really, they can raise, they can cut, they can, it's completely, it doesn't matter in terms of that particular market. And even if the capital expenditure started pouring in now, you're looking at years before you get any result of supply, right? Because it's not like you go, okay, let's turn the taps on, folks. No. If you're going to actually go and build a rig, well, guess what? A lot of the shipyards, they went through bankruptcy. So there's not often the capacity, even in the shipyards, in order to build some of the hardware or the infrastructure that's required to then go out and do the work that's going to bring on the supply of the particular commodity. And this is true of many sectors. So you're already looking at like this friction with respect to time frame. And again, I come back and people are focusing on what the PMI number is or what the Fed might or might not do. I'm like, that doesn't make any difference. It's not going to change any dynamics behind what's going on here. Europe, what's Europe going to do for energy? They got lucky last winter. What are they going to do now? I don't know if folks saw, but the Biden administration now has come out saying, well, the supplies of natural gas, which they basically promised them after the Nord Stream pipeline blew itself up, they now have said that that's no longer in the cards because of climate change. So what are they going to use? I'll tell you what they're going to use. Coal. That's what they're going to go use. And they're still too woke to go and dig it out of the ground within Europe. So guess what? It's going to come from Indonesia.
South Africa.
The
very country they've been trying to get off coal.
Yeah. So, you look at these dynamics, and again, so it's not just like you can see you'll get a bull market, but so there will be certain countries or certain industries within countries, etc., that will benefit, and others that won't. So I'm not suggesting for Europeans to run out there and try and, if they even exist, find some coal companies within Europe, because they're probably not going to benefit. So it'll take a cycle change before, by the time we're done with all of this, Europe will probably be no longer the Europe. I don't think there'll be a European Union. There certainly won't be a euro. But nevertheless, you'll have people will probably be digging coal, and they'll have gone through a lot of pain, and we'll be back to a different cycle. But we're a long ways off that, and we don't really need to bother about what that looks like right now. Right now is just a matter of what's cheap, what's expensive, stay away from what's expensive, and go for what's cheap. Keep it simple, position size accordingly. Don't get over your skis on any one position, keep your head about you and be patient.
Yeah. So how exactly do you guys, for the audience who may not know or aren't subscribed to the newsletter, how exactly do you guys play these different sectors? Do you play like the actual commodity itself, like with SPUT, for example, or do you kind of create your own ETF in a way?
It's pretty much all equities. So we
All
don't
equities.
we don't trade the futures in the commodity markets because we don't like to take on leverage, and there's no need. Frankly, when you get to the bottom of cycles, there's no need to take on the kind of leverage that you get within futures contracts, which also come with risk and time frame issues. If you're buying, think of a decent coal company. Let's use coal. It could be any particular asset class. If you're buying it for a very, very cheap price, you've basically got a long dated call option on that particular market. If you're going into the futures market, sure, you can take leverage, but you have time frame issues. At the valuations that exist, you're basically buying long dated call options with no expiry. Your risk is that something goes wrong in that particular company, or it gets sanctioned, or like something goes on. But that's a risk that you can manage, right? You can take 1-2% position size in any given equity. Let's say you're going into coal. Let's say you want a 10% weighting in coal. Well, you could buy 10 coal companies. You could buy 20 if you wanted.
Yeah.
So,
the old rule is, 80% of a stock price's movement is associated with the sector it's in. And if it's not that, it's 70%. And if it's not that, it's 75%. So it's somewhere there, all right? And so we'll spend most of our time deciding, which sectors to be in, and then to a lesser extent, what stocks to be in those sectors. Usually when it comes to buying these things, we're sort of going, well, okay, which stocks are going to survive and make it to the other side? Because those ones that do, that's all we're going to do, and that's what we're doing in all services. We go back a couple of years, okay, who's going to survive? Who's going to survive? And we'll position those. So yeah, that's how we do it. And well, often there's not a good ETF out there that represents that sector. I mean, you take coal. The coal and shipping, the ETFs just disappeared because no one's interested in them.
And that was the bottom too. Like that was a signal for the bottom.
That was the bottom.
Of course.
That was the bottom. Yep.
Yeah.
So I also want to point out to the audience that it's not just capital gains that you guys look at. You guys also track a dividend portfolio. So you give your subscribers a chance to invest in a capital gain strategy or a dividend portfolio strategy. Is there any difference in terms of like how you select sectors and stocks between the two portfolios?
Yeah. So, well, with the asymmetric strategy, which is what we've been talking about here, is we're looking for sort of sectors unloved and wanted, and we'll sort of focus on those sectors, and we'll get a different exposures throughout the globe. I mean, we've got some Singaporean offshore oil service stocks in there as well. That's all fine, and though we sort of buy things in the anticipation that they're going to be probably up 3x plus on a 5-year view. Something like that. Or it's a hop, skip, and jump to achieve a 3x type return. Not much. Then with the dividend portfolio, that was really designed for folks who wanted a dividend, an income stream. And we designed this about 3 years ago when bond yields were at naught. And so folks came to us and said, "Hey, look, what we do for an income? We're getting nothing from the bond market." And so, Chris and I looking throughout the world, we'd often come across stocks that they were damn cheap. You can tell these things they're probably old classic sort of industries that are sort of discarded by investors. They probably weren't going to go up like 3x on a 5-year view. They could easily double, and they're paying dividend yields of 10% plus. So these were like weird things. For example, a cigarette distributor in Israel. At the time he bought it, 25% dividend yield. P was like 4 or something like that, or 2. Yeah, and it was easy to find these things. It was, who the hell is going to go and buy a cigarette distributor? Anything to do with cigarettes, and B, a stock in Israel. Okay, and so on and so forth. There was a whole bunch of these things. We sort of put them all together. They were diverse. Came from diverse industries, diverse geographical regions, and they're all cheap as chips. So that was our income portfolio, and that's performed admirably. Exactly, it's outperformed. Yeah, just outperformed the S&P 500 since the start of 2021. But let's not get too much into performance details. So yeah, that was that portfolio, and so it was just it's really hard to pass up these ideas that come along. It's like, yeah, geez, that's great, but it's not going to fit in the asymmetric portfolio, but awesome candidate for the dividend portfolio.
Yeah.
I kind of view that as a let's not get run over portfolio, where you go in a world where you got a lot of risks based on overinflated certain overinflated equity markets and overinflated bond markets, and then again answering the question of how do you get an income, then that was our answer to that. So it was both getting an income and how do you not get run over. And largely I think, and then you could say, people would argue and say, okay, well, if you're going into the equity market to solve those problems, you're going to take equity volatility. And we said, absolutely. We would rather have equity volatility than we would have bond destruction potential, right? So if you are like us and you believe that the bond market has topped out and is on a one-way ticket to hell, then that could be something that people would want to look at as, and you don't have to buy ours or whatever, but have a look at deep value equities where you've got low valuations, no or low debt levels, consistency of earnings and consistency of dividend payments. Sure, in a distressed market, you could have equity volatility, but think about it. If you've got a company that's very profitable, you don't have any debt payment problems, you're printing money enough that you can pay out healthy double-digit dividends, like you're way less risky than a government that's bankrupt and the paper issuance that they have. So that solves those problems for us.
Yeah. And on top of that, you guys offer monthly webinars, you answer questions from your subscribers. You have a Slack channel, which I find highly resourceful. Big community there, always posting, new things to look at and research. And then you also have a video series in terms of how to actually invest, your investment philosophy. I've made it no secret on this channel that I really started my investment journey back in 2020, and a large part of my knowledge base came from your newsletter, Capitalist Exploits. So I always recommend it to people. I have the link down below for people that are interested. I highly recommend it. I am still a member to this day. But yeah, Chris, Brad, I really appreciate your time. Before we wrap everything up, any closing statements, closing thoughts, or like things that you feel give Capitalist Exploits an edge to the average investor? Chris.
The edge, and this is this is an edge that any retail investor can have. And that edge is quite simply patience. If you look at what the market in the 1960s, the average hold time on an equity was 14 years, which meant at an individual would go and buy an equity and then hold it for 14 years. I haven't looked at the numbers for the last 2 years, but about 2 years ago, maybe even 3 years ago now, time's running out, that was down to less than 3 months. The results of any or the impact of anything going on in the market that will change or alter the course of a particular company within 3 months is highly unusual. It doesn't, right? So why would you be buying and selling within a 3-month time frame? And these are people that are considering and telling you that they're investors, not traders. So what I'm saying is that the whole time frame has been constricted massively. Your average investor has literally moved into the TikTok world where their time frame is down to like 30 seconds. Oh, I bought it. It hasn't moved in 30 seconds. Fuck it. I'm selling it. Like when the whole world is treating it like that, there are gems out there. But in order to participate in those gems, you need to have the balls, I would say, to just do what others are not prepared to do. And in large part, that's looking at something and saying, you know what, that's cheap. And you buy it. And then tomorrow it's 10% cheaper and you go, it's still cheap. You relax, you chill out. You've only taken a 1% position size and you let the market do what it's going to do over the time frame. So I would say patience is the greatest element that individuals can have over and above the market, because the big black box algo trading systems don't have it, because they're just trying to move capital and they're trying to keep capital aggregated and allocated to their mutual funds and so on and so forth. And so for them, in most respects, they just don't want to like lose against the benchmark. I honestly don't give a shit about any benchmark. We don't. Now, all of our clients that come into Glenorchy, we make it very clear as to what we're doing and how we're doing it. And touch wood, that's been fantastic, because our clients know and understand what we're doing and they're okay with it. Some people aren't, but I would suggest that is the greatest advantage that as an individual you have in the market today, because you've got this massive algo-driven passive income capital pool that's just chasing stuff, and you don't have to. You don't have to.
Well,
yeah.
You took the words right out of my mouth. I will say this. The other thing would be asymmetry. Keep asymmetry on your side. You know, the things we're investing in, if we just get one thing right, which we hope we can do more than that, you know, it can make up for the things that don't go right. You know, so instead of often you hear, oh, this person blew up because, you know, had one trade go against them type thing. Well, you know, flip it on its head and just position yourself with lots of little blocks of asymmetry. Try and have them unrelated to an extent. And then, you know, eventually your ship's going to come in, and you just got to have the patience to be at the table when your turn to get lucky comes around. There we go.
Yeah. Yeah. And another thing I like about you guys is that, you know, you keep it real. You know, if you're one of those people that are, you know, overly concerned about, you know, gender transitioning over, let's say, the actual energy transition, then probably capital sexual is probably not for you. You know, you guys keep it, you know, you don't shy away from, let's say, spicy topics. And that's another thing that I think gives you guys an edge. You're willing to.
We live in a world of absurdity, and it's absurdity within the financial markets, and it's absurdity within the social constructs. People are being led to believe things that are absolutely clearly not true. And so we call a spade, and frankly, I think you said it right. It's if you're going to be upset or triggered by things that are obvious to any rational thinking human being, then this is not for you.
Yeah. But you know, if you're concerned with the real world implications, you know, I can't recommend Capitalist Exploits enough. So with that said, you guys, if you enjoyed this content, be sure to give this video a like, Comment down below. Let me know what you guys think. Do you agree or disagree with any of the points made in this video? And as I mentioned before, we have the link to Capitalist Exploits down below. I am a subscriber to this day. It's been almost 4 years since I started my investment journey, and Capitalist Exploits has been, the very bedrock of my knowledge base. So, Chris, Brad, I really enjoyed it, gentlemen. Thank you so much for coming on.
Right. Thank you.
Been a
Thanks so
pleasure.
much.
Thanks so much.
All right.
Take care.
With that said, I will see you guys in the next episode. Bye, y'all.